Hello, I'm Chris Pedersen and this is Stock Watch on Wednesday, the 14th of August, 2024. All information is general advice and may not be suitable for you. Always consult your advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. Here are a couple of my market observations. The ASX right now is at 7,892. This has recovered almost the entire recent decline. Amazing what happens in just 1 week. Copper and iron ore have trended downwards. They've bounced a little bit, but the trend is down. 10-year Aussie government bond yield to maturity is 4%. This is down from a few weeks ago or last week at 4.3, 4.4%. Wholesale inflation rate in the United States, which is the Producer Price Index or the PPI, was only 0.1% in July. The markets are rallying on this good news. Hopefully tonight the CPI will also show inflation is slowing, and now it's a matter of will the Federal Reserve be able to cut rates or not. Superannuation. I've got a few comments here. I've mentioned this before. How to perform better than the big super funds. Use ETFs and the low-cost ones that are replicating broad-based indices. After all, what super funds do is asset allocation. Well, you can do the exact same thing with exchange-traded funds, except have less costs. The result? You have more money in your pocket. It is not complicated to do. All you need is some basic information on the exchange-traded funds, like what are the returns, what are projected long-term returns, and what is their volatility, which is code for risk, because you then can translate the return into risk-weighted return. And that's what it's all about. 3 companies I want to cover today. First is ANZ Bank, code ANZ of course, and it's trading on the ASX at around $28.84. This is a 5-year chart. It's been bouncing around, but the reality is it's kind of been going nowhere for quite some time. Will it go higher? Let's take a look. These estimates are from Goldman Sachs. There's a market cap for ANZ of about $87 billion. Their price target is $29.42. Revenue growth rate they're showing from 2023 every year up to 2026 is only 3% per annum. This is less than the inflation rate. That's not so good. And what you really want to do is inflation rate plus population growth rate means you're breaking even. Earnings per share growth for 2023 to 2026 period is negative 1% per annum. And the dividend growth in this period is negative 2% per annum. The PE on the 2025 earnings estimate of $2.24.9 is 12.8 times. That's not too high. However, banks traditionally are around 11 to 12. This is towards 13. It's a little bit on the high side, but why is this? The yield on the 2025 dividend estimate of $1.66 is 5.75%. This is why it has a higher PE. That's because the yield is keeping the price up. The cost to income ratio, this is very important for banks and why I included it here, is 51.6%. This is a poor number. The banks for a long time were around 45%. Then they crept up over 55% and they've trended down to 50 or 51%. The reality is for banks to grow their earnings, they need to get their costs down. They're having a lot of trouble finding out how to do that. One major reason is technology costs are going through the roof. The payout ratio for ANZ at 72.5%. This is one of the lowest of the major banks, which is positive for them. They're obviously one of the larger banks, one of the big 4. They have small revenue growth, flat earnings per share, flat dividend growth. There's no ability right now to cut costs. It has a good yield. I rate it neutral. Apple Computer is the second company today. It trades in the US under the code AAPL, and in US dollars it closed last night at $221.27. This is a 5-year chart also. It's been nothing but upwards. Will it continue? Now, Warren Buffett recently sold half his stake. Why would he sell a stock that is performing so well? It's been a massive performer for Berkshire Hathaway. Well, let's take a look at the numbers. These estimates are by UBS. The market cap right now is 3.4 trillion. This is US dollar trillion, which means in Aussie dollars it's over 4 trillion. Think about it. 12-month price target UBS has is $190, which is more than $30 below where it's currently trading. Revenue growth for each of the next 3 years is only 2.3%. This is a massive decline from where it's been the past 10 years. The earnings per share growth in each of the next 3 years is very low now, also at 5.4%. And the dividend growth in the same period is only 4% per annum. So I then took a look at shareholder equity growth, and surprise, it's only growing at 1% per annum. Apple has hit a wall. Yes, they're growing, but very slowly. The PE on the 2025 earnings estimate from UBS of $6.88 is 32 times. The yield on the dividend for 2025 of $1.02 is only 0.5%. In America, people don't buy tech stocks for dividend yield. They want the company to take the earnings and reinvest for more growth. Free cash flow for Apple is only 3.5%. Payout ratio is only 15%. So then I took a look at Apple's and their cost-income ratio out of curiosity. It's at 67%. It's between 66, 67%, and it's been there for some time. In other words, they're having trouble cutting costs also. The PEG ratio, which is a good indicator of is it an attractive growth stock to buy. If it's a PEG of 1 or lower, that's good. Well, Apple's PEG right now is 5.9 times. As a reminder, PEG is the PE ratio divided by earnings growth rate. Right now, we know from these numbers why Buffett has sold half his position. I would not be surprised if he continues to sell. Apple has been an amazing company, but its growth has slowed. I'm neutral on it. I hate to say I'm a sell because these numbers show you should sell, but Apple, for some reason over the past few years, has continued to prove me wrong. This time, though, I'm pretty confident, neutral or lighten up. Netwealth is the third company, and the code on the ASX is NWL. It's trading at $20.70. This also is a 5-year chart. It's really taken off lately. These estimates are from Morgan Stockbroking. It has a market cap of $5 billion. 12-month price target, according to Morgan's, is $20.50. So that's 20 cents lower than where it is right now. Revenue growth rate for each of the next 3 years is a solid 18% per annum, and the earnings growth is 22% per annum, and the dividend growth is 21% per annum. These are all excellent numbers. Shareholder equity growth is also attractive at 17% per annum. Now let's look at the PE ratio. The PE on the 2026 earnings per share estimate of 51 cents is 40 times. The yield on the 2026 dividend estimate of 43 cents is 2.1%. I'm not fussed about that. Growth companies, it's okay if they have a low yield. The free cash flow is only 2%. To me, that's a problem also. The PEG ratio is 1.8. That's a little bit high. The payout ratio is 85%. I don't know why they feel a need to have that big of a payout ratio. This is a leading wealth platform. For me, it's too expensive on a PE basis. One of these days, platforms will get cheaper due to competition and the profit margins will shrink. I'm neutral on Netwealth. They might show good growth for the next few years, but at a 40 PE, the growth rate is a little bit too slow for me. As always, if you want to learn more about the 3 companies I covered, send an email request to stockwatch@fnn.com.au, and also let me know if there's any companies you'd like for me to take a look at. Hope you have a good, profitable week. Thank you for your time.